Hi everyone, I'm David Scranton from the Income Generation, and people are debating now how much they should be concerned about the volatility going on in today's financial markets. And there's a lot of people that perhaps, should be concerned, but they've got almost a stalwart type attitude saying, well, I've lived through this before, peaks and valleys, I'm not going to worry about it. Okay? There's others that maybe shouldn't be concerned but are outright panicking. And as most things in life, the truth lies somewhere in the middle. So first of all, who shouldn't be concerned? Well, if you've got certainly 15 years or more to go until retirement, and some might say 10 years or more, and this is retirement money, you're not going to need the money for at least 10 or 15 years, then you probably shouldn't worry about it. Unless, of course, you think there's going to be a bigger drop and then you're going to panic and sell. But as long as you know that upon a bigger drop, you won't panic and sell, statistically speaking, 15 years from now, chances are the market will be higher than today. In which case, if you have the stomach for it, you probably shouldn't panic. You probably shouldn't worry about it. Financial advisors are right when they tell you, look, don't pull up your accounts online every day. Don't look at them. You drive yourself crazy. You look at them once a quarter, that's enough. And that's good advice, but under one circumstance. And that is you have 15 years until you need that money. If you need it beforehand, then that might be bad advice. So again, if you have the stomach for it, you've got a long-term time horizon, don't worry about the headlines, don't worry about what's going on. In fact, if you're going to worry about it, it's only as a buying opportunity. It's only if you have money sitting on the side waiting to get in the markets. Well, maybe a nice 10% pullback, depending upon your situation, might just be a great time to get in and buy things when they're a little bit on sale. As the talking heads on a lot of the major financial networks like to say, buy the dips, right? But what if you have less than a 15-year time horizon to your goal, or especially less than a 10-year time horizon? Or what if you're already retired? Now should you be worried about the dips? Well, it depends. It depends upon whether you're generating the income that you want from interest or dividends, or whether you're engineering income through converting capital gains to income. Now, be careful. You might say, oh, I'm getting enough income from interest and dividends and I'm fine for now. But be careful, because remember, if you have IRA money, when you turn age 72, you're going to have to take out 4% per year, so says the government, whether you want it or not. So even if you don't feel like you need it, but you're going to be age 72 within 10 years or so, you still want to be careful. So what do I mean by engineering income from growth? Well, several theories that came out, starting really in the 1940s and 50s, started to give people on Wall Street the idea that maybe you could engineer income from growth. And a lot of these things were written by economists that are very intelligent. Some of these economists even won Nobel Prizes for their theories, that you can stay in growth-oriented instruments longer than you want and simply sell shares on a regular basis, and over time, you'll be ahead of the game. You could still get more return on your money. But a lot of these theories were really back-tested during a good time. They weren't back-tested during bad times. And we've seen several occasions over the last 20 years where these strategies simply didn't work. So what do I mean? Well, the equation for, and you hear me talk about this all the time, the equation for total return is simple. It's total return equals income plus growth. Income is in the form of interest and dividends, and growth is in the form of capital appreciation. Right? So when you're in your accumulation years, more than 10 or maybe even 15 years from retirement, you're looking at total return. And you really don't care whether it comes from the income side, the interest and dividend side, or the growth, the capital appreciation side. You just want to make money on your money. But when you're retired and you're in the income years, and when you're in those transition years between the accumulation phase and the income stage, those 10 to 15 years before retirement, then you also care. And that's when all of a sudden total return shouldn't be your priority anymore. It should be income, making sure that you're getting income from your portfolio. And then growth and total return is really a secondary goal. But a lot of people lose sight of this because they had a good market leading into retirement. So they said, well, I can stay growth oriented, I can stay total return focused, and just take some withdrawals from my account each year. And it's fine, because if I take the withdrawals, the accounts will grow right back. Now, if you tried this strategy in the 1990s, you did fine, because there wasn't a lot of volatility in the market. If you retired in 2009 and you did this, well, then the first 10 years of your retirement, the strategy worked fine too. Why? Because the market went almost straight up. So every year you sold some shares and you try to convert the growth into income by taking principal, right? That's really what you're doing. You're taking principal and crossing your fingers and toes and hoping it grows back. That would have worked fine. But what if you did it in 1999, 2000, or 2001? Well, then it wouldn't have worked so fine. Because if you had a portfolio, let's say $1 million, and you were taking 4% a year out, by 2013, you would have only had about half your money left. So now you're still pretty young, you're still early on in retirement, and you've spent half your money. If you retired in 2007, it would have happened all over again. The market dipped with the financial crisis, and when you took that principal, it wouldn't have grown back for the first few years. And it would have happened again if you retired in 2019, and all of a sudden, bam, you saw your money decline when COVID-19 hit, and the market took almost a 40% drop in the spring of 2020. So should you be concerned about volatility? Yeah, you always should be concerned if you're going to be taking income within 10 or 15 years. And now, why do I say 10 or 15 years? Because again, from 2000 to 2015, the market acted like one big W. The market was underwater for most of those 13 years. So if you even sitting in 2000 plan to retire 13 years later, you wouldn't have made it any growth in the market. All you would have gotten is the dividends, and that's it. So the key, if you're in those transition years, the 10 to 15 years leading up to retirement, is to make sure that you're getting enough income, interest, and dividends to satisfy your retirement needs. Or if you don't have enough money to quite do that, you're getting a decent amount of interest and dividends, the most you can in the stock market or in your non-stock market-based investments. Because if you're maxing out those interest and dividends, then if the market drops, you actually have staying power, where you're not going to have to sell should you retire or get forced into retirement, because you're still getting the maximum income you can from your portfolio. And moreover, if you don't lose your job in a down market and you stay employed preparing for retirement, guess what? Well, now you get all those interest and dividends that get paid out to you, and because the market's now dipped, now you get to buy even more shares when you reinvest those interest and dividends, because you're buying more shares at a cheaper price, which means when the market does recover, you're ahead of the game. So if you took somebody, for example, who was just break even in 2013 versus 2000, but instead they invested in the stock market and had a 4% dividend yield, imagine what that person would have done if they could have reinvested that 4% every year. Over 13 years, they would have grown their portfolio by 50% by reinvested dividends. But it would have been even better than that. Why? Because as the markets dipped, they would have bought stocks cheaper. They might have been up closer to 70%, while a lot of other buy and hold investors were just break even. So yeah, if you're within 15 years of retirement, you need to be concerned about volatility? Sure. But does it mean you need to panic and take your money out and put it in bank CDs? No. It just means that you need to focus on income first. And you can even keep a good chunk of that money in the stock market, providing that you're getting a very comfortable dividend. And I talk to people every day who don't know they can get it. Right now, the dividend yield on the broader stock market, the S&P 500, is about 1.4%. But you know what? I'm here to tell you, you can get triple that. You can get over 4% in high dividend paying common stocks today. Now, it's not easy to do, so you may not want to try this at home, but you can get 3 times the income yield, the dividend, in a stock portfolio and not lock yourself out of the upside. But if this volatility turns against you, now you've got that 4+% getting reinvested and dollar cost averaging, enhancing your dollar cost averaging effects. So do you need to be worried about a volatile market? No, but you need to react to it positively to protect your portfolio and to give you a little bit more upside. Yes, you do, especially if you're within 15 years of retirement. I hope this helps. If you like this video, please press the thumbs up button to give us a thumbs up to let us know you liked it. And go ahead and follow us on our YouTube channel. Thank you.